Most traders lose money on the 15-minute chart because they treat it like a slot machine. They enter trades based on gut feelings, chase price movements, and wonder why their account bleeds red day after day. The 15-minute time frame sits in a unique position where institutional algorithms clash with retail emotion, creating patterns that repeat with mechanical precision if you know what to look for. This isn't about luck or intuition. Profitable traders follow specific rules that turn the chaos of intraday price action into consistent gains. These 6 rules separate traders who make withdrawals from those who make deposits. The 15-minute chart comes alive during specific hours when major markets overlap. Trading outside these windows is like fishing in an empty lake. You might get lucky, but the odds work against you. The London-New York overlap from 8 a.m. to 12 p.m. Eastern Time produces the highest volume and cleanest price movements. This 4-hour window accounts for over 60% of daily forex volume and generates the most reliable setups across all markets. Asian session trading on a 15-minute chart carries different characteristics. Price ranges contract, spreads widen, and false breakouts multiply. Retail traders love these quiet hours because they see movement and assume opportunity. Professional traders avoid them because the movement lacks institutional backing. When banks and hedge funds step away, the market becomes a playground for algorithmic spoofing and low-volume manipulation. The first hour after the New York Open deserves special attention. From 9:30 to 10:30 a.m. Eastern, stocks experience their highest volume of the day. This period produces genuine breakouts and trend continuations backed by real capital flow. Compare this to the lunch hour between 12 p.m. and 2 p.m. Eastern, when volume drops and price action becomes erratic. Trading the same strategy across different volume environments guarantees inconsistent results. Track volume alongside price on your 15-minute chart. Most platforms offer volume indicators that display transaction activity for each candle. Look for volume spikes that confirm price movements. A breakout above resistance means nothing if volume doesn't increase. An upward price move on declining volume signals weakness, not strength. This simple check filters out half the losing trades most beginners take. Futures traders need to adjust these windows based on their contracts. ES and NQ futures often produce their best setups during the first 2 hours after the equity market open and again during the final hour before the close. Crude oil comes alive during the London session when energy traders position for the day ahead. Each market has a personality tied to when its primary participants actively trade. The worst mistake you can make is forcing trades during dead hours. Your strategy might be perfect, your analysis spot on, but if the volume isn't there, the market won't move in your favor with any consistency. Professionals walk away from their screens during low volume periods. They understand that trading is about probability, and probability shifts dramatically based on participation levels. Indicator overload destroys more trading accounts than any other technical mistake. Traders pile moving averages, oscillators, and custom tools onto their charts until price action disappears beneath a rainbow of lines. Each additional indicator adds lag and creates conflicting signals. The cleanest setups use exactly 3 confirming tools that measure different market dimensions. Start with a trend indicator. The 20-period exponential moving average works exceptionally well on 15-minute charts. When price trades above this line, you look for long setups. When price trades below, you look for shorts. This simple filter eliminates counter-trend trades that account for the majority of retail losses. The EMA responds faster than simple moving averages, making it ideal for the quick pace of 15-minute trading. Add a momentum indicator next. The RSI with standard 14-period settings identifies overbought and oversold conditions, but don't use it the way beginners do. An RSI above 70 doesn't mean you should sell. It means the trend has strength. An RSI below 30 doesn't mean you should buy. It means the downtrend has momentum. Use RSI to confirm the direction suggested by your moving average, not to pick tops and bottoms. Your third indicator should measure volatility or volume. The average true range shows you how much a market typically moves in a given period. On a 15-minute chart, ATR helps you set realistic profit targets and stop losses based on actual price behavior. When ATR expands, markets are moving. When it contracts, expect choppy conditions. Some traders substitute volume for ATR, watching for increases that confirm breakouts. These 3 indicators measure trend, momentum, and volatility. Together, they give you a complete picture without cluttering your analysis. When all three align, your probability of success jumps significantly. When they conflict, you have no trade. This disciplined approach prevents the confusion that comes from watching 10 indicators give 10 different signals. Many traders ask about MACD, stochastic, Bollinger Bands, and dozens of other popular tools. Each has merit, but more tools don't increase accuracy. They increase analysis paralysis. Professional traders often use even fewer indicators than 3. Some trade pure price action without any indicators at all. But if you're going to use them, 3 complementary tools give you structure without complexity. The specific indicators matter less than consistency. Pick 3 that make sense to you and master them completely. Understand how they behave in trending markets versus ranging markets. Know their strengths and limitations. A mediocre strategy applied with perfect consistency beats a perfect strategy applied inconsistently. Your 3 indicators become the lens through which you view every potential trade. Profitable trading requires a specific edge, not a general approach. Your edge is the repeatable pattern or condition that gives you a statistical advantage. Without a clearly defined edge, you're gambling with extra steps. Before the market opens, you should know exactly what setup you're hunting and what conditions need to exist for you to pull the trigger. Write down your edge in one sentence. It might be buying breakouts above the opening range when volume confirms and RSI shows strength, or fading the first move into major support when momentum diverges. The specifics matter less than the clarity. If you can't articulate your edge in a single sentence, you don't have one yet. Your edge should exploit a specific market inefficiency or behavioral pattern. Markets mean revert after extreme moves because profit takers overwhelm new buyers. Markets trend when institutions accumulate positions over multiple candles. Markets consolidate before major news because informed traders wait for clarity. Each of these patterns represents a potential edge if you can identify and exploit it consistently. Backtest your edge across at least 100 trades. Use historical data or a replay tool to see how your setup performed in the past. Calculate your win rate and average risk to reward ratio. An edge with a 40% win rate can still be profitable if winners average twice the size of losers. An edge with a 70% win rate might lose money if you let losers run and cut winners short. Most traders skip this step and wonder why they can't achieve consistency. They trade different setups based on mood or market conditions, never developing expertise in any single approach. Specialists beat generalists in trading just like every other field. The trader who masters one specific setup will outperform the trader who takes 10 different types of trades. Your edge should fit the 15-minute time frame specifically. Patterns that work on daily charts often fail on 15-minute charts because the underlying dynamics differ. Daily charts reflect fundamental shifts and position trading. 15-minute charts reflect intraday supply and demand imbalances. Your edge needs to match the time frame you trade. Once you define your edge, you wait for it. You don't take trades that almost fit or sort of look right. You wait for your exact setup with all confirming factors present. This discipline separates professionals from amateurs. Amateurs find reasons to trade. Professionals find reasons to wait. On a 15-minute chart, your perfect setup might appear 3 times a day or 3 times a week. Either frequency is fine as long as you only trade when conditions match your criteria. Position sizing kills more trading careers than bad entries or wrong market calls. Traders who nail the direction still blow up their accounts by risking too much on individual trades. The 1% rule is non-negotiable. Every trade should risk exactly 1% of your total account value, measured from entry to stop loss. Calculate this before you enter. If you have a $10,000 account, each trade risks $100. If your stop loss sits 20 cents below your entry on a stock trade, you can buy 500 shares. If your stop loss sits 50 cents below your entry, you can buy 200 shares. The distance to your stop loss determines your position size, not your confidence level or how much you want to make. This mathematical approach removes emotion from sizing decisions. You don't increase risk because you feel certain about a trade. You don't decrease risk because you're nervous. Every trade gets exactly 1%, regardless of how obvious or questionable the setup appears. This consistency ensures that a string of losses won't devastate your account, while a string of winners builds capital steadily. The compounding effect of 1% risk works in your favor over time. Assume you have a modest edge that wins 55% of the time with a 1.5 to 1 reward to risk ratio. Starting with $10,000 and risking 1% per trade, you'd grow to over $13,000 after 100 trades. The same edge with 3% risk per trade could blow up the account during an inevitable losing streak. Traders constantly argue for larger risk per trade. They claim 1% grows accounts too slowly or doesn't make trading worthwhile. This mindset reveals a fundamental misunderstanding of professional trading. Professionals focus on process and probability, not home runs. A trader who consistently makes 2 to 3% monthly returns becomes wealthy over time through compounding. A trader who swings for 10% monthly returns typically achieves 0% because they eventually hit a streak that wipes them out. The 15-minute time frame tempts traders to overtrade and oversize. You see multiple setups per session, and the action feels manageable compared to faster scalping timeframes. This comfort leads to position size creep. You start risking 1.5%, then 2%, telling yourself it's still conservative. Before long, you're risking 5% per trade, and one bad day costs you a month of gains. Stop losses on 15-minute charts should reflect the chart's volatility, not your pain threshold. Use ATR to set stops at logical levels beyond normal price noise. If ATR shows that the market typically moves 30 cents in 15 minutes, your stop needs to sit at least that far from your entry. If this makes your position size too small to meet the 1% rule, you either need a larger account or a different time frame. Exit rules matter more than entry rules, yet most traders spend 90% of their preparation time looking for entries. They nail the entry, watch the trade move in their favor, then sabotage themselves by exiting too early or too late based on emotion. Predetermined profit targets eliminate this problem completely. Set your profit target before you enter the trade. Use support and resistance levels, Fibonacci extensions, or risk-to-reward ratios. The specific method matters less than having a plan. If you're buying at support and targeting resistance, mark that resistance level before you buy. If you're using a fixed 2-to-1 reward-to-risk ratio, calculate where that puts your target before you enter. Many traders prefer to use previous swing highs and lows as targets. On a 15-minute chart, identify the last significant high or low within the current session. These levels act as magnets where price tends to pause or reverse. Taking profit just before these obvious levels often works better than waiting for price to touch them exactly, as other traders pile in at round numbers and visible technical points. Trailing stops sound appealing but often lock in minimal profits. The market needs room to breathe, especially on a 15-minute time frame where each candle can show significant range. A trailing stop that's too tight gets you out during normal retracements. A trailing stop that's too loose offers no real protection. Most successful 15-minute traders use fixed targets and move their stop to break even once price moves halfway to their target. The break-even stop serves as a powerful tool. Once your trade moves enough to justify the original risk, move your stop to your entry price. This creates a free trade where your downside is eliminated, but your upside remains intact. On the 15-minute chart, price often makes a quick move in your direction, pulls back to test the breakout level, then continues to your target. The break-even stop keeps you in the trade through that pullback. Partial profit taking provides another option. Exit half your position at your first target, then let the remainder run to a second target with a trailing stop. This approach locks in some profit while maintaining exposure to extended moves. The psychology improves as well because you bank to win even if the second half stops out at break-even. Never exit a trade simply because you're up a certain dollar amount. That amount means nothing without context. A $50 profit might represent a 0.5 to 1 reward-to-risk ratio on one trade, and a 3-to-1 ratio on another. Judge exits based on price action reaching predetermined levels, not your emotional comfort with the profit shown in your platform. The flip side also applies. Don't hold trades beyond your target hoping for more. When price reaches your predetermined exit, you get out. Overriding your rules based on greed destroys the statistical edge you've built. Your rules exist for a reason. Follow them even when your gut screams to stay in for more profit. Professional improvement requires detailed feedback on every trade you take. Most traders either skip this completely or review only their losses, creating a skewed understanding of their performance. You need to review every trade, winners and losers, within 24 hours of closing it. Create a trading journal with specific fields for each trade. Record the setup you saw, why you entered, where you placed your stop and target, and how the trade developed. Include screenshots of the chart at entry and exit. Write a brief narrative explaining your thought process. This documentation serves multiple purposes beyond simple record keeping. First, the journal holds you accountable to your rules. If you claim to only trade specific setups, your journal proves whether that's true or just how you perceive your trading. Many traders discover they take different types of trades than they think they do. The journal provides objective truth about your actual behavior versus your intended behavior. Second, the journal reveals patterns in your performance. You might notice that trades taken in the first hour of the session perform better than trades taken later, or that your win rate drops significantly on Fridays, or that you manage winning trades perfectly but consistently cut losing trades before your stop gets hit, turning small losses into missed opportunities when price reverses. Third, the journal accelerates your learning curve. When you review a trade 24 hours later, you see things you missed in the moment. Maybe you entered before all 3 of your indicators confirmed. Maybe you chased price instead of waiting for a pullback. These realizations feel painful, but they prevent you from repeating the same mistakes. Grade each trade on execution, not outcome. A perfectly executed trade that loses money deserves a high grade. A sloppy trade that makes money deserves a low grade. This distinction is critical. Your job is to execute your process flawlessly. The market determines outcomes. If you execute well and lose, that's trading. If you execute poorly and win, that's luck. The journal helps you separate process from results. Track your statistics weekly and monthly. Calculate your win rate, average win size, average loss size, and profit factor. Plot these metrics on a simple spreadsheet. Look for trends. Is your win rate declining? Is your average loss growing? These warning signs appear in the data before they show up in your account balance. Early detection allows early correction. Many traders resist journaling because it feels like homework. They'd rather spend that time looking for the next trade. This short-sighted approach keeps them stuck at their current level. You cannot improve what you don't measure. You cannot fix mistakes you don't acknowledge. The journal transforms trading from a series of random bets into a structured process of continuous improvement. The 15-minute chart generates enough trades that patterns emerge quickly in your journal. After a month of consistent trading and reviewing, you'll have clear data on what works and what doesn't in your specific approach. This empirical feedback beats opinion, hope, or guesswork. Your journal becomes a personal trading textbook written specifically for your development. These 6 principles create a complete framework for 15-minute chart trading. Trade during high-volume sessions to ensure clean price action and tight spreads. Use 3 confirming indicators to filter setups without cluttering your analysis. Define your specific edge before the market opens so you know exactly what you're hunting. Risk exactly 1% per trade to protect your capital through inevitable losing streaks. Take profit at predetermined levels based on technical analysis, not emotion. Review every trade within 24 hours to accelerate your learning and hold yourself accountable. None of these principles involve prediction or genius market calls. They don't require expensive software or insider information. They work because they address the real reasons traders fail on intraday timeframes: lack of structure, emotional decision-making, inconsistent position sizing, absence of feedback loops. The 15-minute chart punishes these weaknesses ruthlessly and rewards disciplined execution consistently. Start with the first principle tomorrow. Trade only during the London-New York overlap or the first 2 hours of the US stock market session. Track how this single change affects your results. Once you've mastered high-volume trading, add the second principle. Simplify your indicators to 3 confirming tools. Layer in each principle sequentially rather than trying to implement everything at once. Mastery takes time. You won't transform into a profitable trader overnight by reading these principles. But if you commit to implementing them systematically, measuring your results honestly, and making corrections based on data, the 15-minute chart shifts from a source of frustration to a reliable income generator. The patterns repeat, the opportunities recur. Your job is to show up prepared, execute your process, and let probability work in your favor over a sufficient sample size of trades. The difference between profitable traders and losing traders isn't intelligence or luck. It's adherence to proven principles that control risk and exploit edges. These 6 principles provide that framework. Your discipline determines whether you join the small percentage of traders who actually make consistent money or remain part of the majority who fund their profits.